the Kenyan shilling firmed after the central bank intervened to prop it up by selling dollars to commercial banks. Now, for an update on the shilling's performance, we're joined now by Duncan Kanutia, Head of Trading at the Commercial Bank of Africa, and Beatrice Gachenge is going to be talking to him. Over to you, Beatrice.
Many thanks, David. With us in studio is David Kinothia, as you rightly said. He is the head of trading at Commercial Bank of Africa, and we'll be discussing the strength that we saw today in the currency, whereby it closed the session at 84.80, 85 flat, and this is compared to yesterday's close of 85.10.30. Many thanks for joining us. Okay. Now, we saw the central bank intervening today, selling dollars, and of course we have seen an 8-week low on the currency. Is it something we're likely to see the central bank continuing?
Well, it's important to note that the reserves have been growing quite significantly, and to some extent I think what they're not happy with is a rapid slide of the shilling. So when you look at where we were 2 weeks ago, 83, 80, 84, and now we are talking about 84, 85, 30, 50 that was seen today. I guess that was a massive slide considering how we've been stable in the recent past. So for them, I think it's just a message that they'll not stand by the side and watch as it slides. So I guess today it was just one of those, try and stem the slide before it becomes too much.
But looking at the reasons why it was sliding, it was due to end-month obligations, as importers, major importers and manufacturers were buying dollars to make their financial obligations. And now, I mean, the month is coming to an end tomorrow. Does that mean that you're going to revert to normal activity?
Well, it will be also important to look at why it gained so much, even when there was end-month demand in the previous month. We had a lot of money coming in looking for yield. And that was when we had the one-year paper was trading at around 12, 60, 70 levels. And we had also the infrastructure bonds trading at around the same levels. So a lot of money came in looking for yield. And so we had massive dollar inflows coming in at a time when demand had subsided. We were just having the lull from the elections. And so when you look at that and now you compare it to now, businesses are starting to pick up. So there's quite a bit of demand from the corporates. Then we're not having as good inflows from people looking for yield, because already we've seen the curve has corrected. So I'd say this is a multiplicity of factors. A, from the corporate side, B, from, fewer dollar inflows, and also, I guess at some point, 83.50 created a flaw, saying that we never were able to breach it convincingly.
Still staying on the track of yields, we've seen the 182 and the 364, which we are just about to get some the results today from the central bank. They're auctioning those two papers today. But previously, from last week's sale, it was massively oversubscribed, with a lot of interest on the one-year treasury bill, attracting almost fivefold in terms of subscription. Do you see that continuing to happen, and what is the impact also on the currency?
Well, seeing that it's come down almost 200 basis points, 270 basis points from the high, I expect activity to start subsiding on that paper in particular, because 12% was quite decent for 1 year, even for anyone looking to invest on the shorter term. And what has happened is there's a correction across the whole curve. And so as you see the 91 and 182 day bills come to single digits, and then you notice the overnight is trading at around 6.7%, the repos are at around 7%. When all those rates start converging, then you may start seeing people preferring to invest on the shorter end of the curve, that is on the repos, as opposed to going for T-bills that are much longer, offering a lesser rate. So I expect as the 364-day comes below 10, activity to start subsiding.
And of course, you've mentioned the interbank rate, whereby it's coming in at 6.9%, and it's been hovering at that level for some time. Is that an indication that we have a lot of liquidity in the market, and why is it finding its way?
Well, there's been lots of liquidity, and you've seen the central bank trying to mop it up on a regular basis. And what tends to happen is up until it's very clear, most investors would like to keep money at least on the shortest end of the curve. But what you're starting to see now is the 20-year was quite well subscribed, meaning that investors are now starting to take up risk again. We've started seeing a pickup in secondary market trading activities on the bond markets. So with the investors starting to see other places to put in their money, you'll start seeing some of this money going away. You also have to remember that the 364-day bill used to be a monthly affair.
Yes.
Now it's become a weekly affair. This was done to mop up this surplus liquidity. And with the way that they've been mopping up on a weekly basis, I guess at some point they'll have to stop. And that's when they see that they've built with the excess liquidity that was floating around.
Staying on the curve of excess liquidity, the central bank was mopping up, was intending to mop up 12 billion, but only got half of it.
Yes.
Why are we seeing this low take-up very quickly?
Like I said before, possibly it could be yield. You don't want to lock in your money for 14 days if you can try and get the 10 on the 1 year and try and run the gap.
Yes.
Because looking at the way it's been, double digits seem to attract quite a bit of interest, regardless of the tenor. And so most investors now are questioning themselves and saying, hey, do I lend money to my customers or do I place it in the 1 year bill? What are the other opportunities that I can invest in and get a better return rather than place it with the central bank for 7 or 14 days and have some reinvestment?